Welcome back, everyone, to my stock market weekly update series, which I normally post on Saturdays, but something came up this week. Had to post it on Sunday instead. But either way, we've got a ton of really interesting things to talk about because we just wrapped up the second week of trading for October. We've got quite a few things going on here. We had earnings season kick off this week with the big banks reporting earnings, which is a really interesting time to take a look at banks because rising interest rates, of course, helps banks, but at the same time, a struggling economy also hurts them. So we'll take a look at that. I'll let you know how the macroeconomy is affecting the banks and what they reported. We'll also take a look at inflation. We just had CPI numbers come in for the month of September, so I'll give you an update on where inflation is at, what that might mean for interest rates, and how it's affecting the stock market. And of course, we'll take a look at the biggest gainers and losers for the past week. And I'll let you know if any stocks catch my eye this week and if there's anything here for possible investment in the future. But it's going to be a fun one. Hope you guys enjoy it. As always, I put chapters for you down below, so if you want to jump to any specific part, you're more than welcome to. But let's go ahead and jump into this and start by taking a quick look at the markets. And so pulling up the S&P 500 here, we can see that Thursday was really the only strong day for the week in terms of performance, with literally every other day being a decline, especially on Friday, which left the index negative for the week by over 1.5%. This now leaves the S&P 500 down about a quarter of its value for the year and 26% from its highs. If you think that's bad though, the tech-heavy Nasdaq continues to perform even worse with over a 3% drop this week, leaving it now down over 36% from its highs. That is a very large crash there for such a large index. Overall though, a little mixed results here for the week in particular, but mostly to the downside. And that's because the market news was also a little mixed for the week, but mostly negative as well. For example, retail sales for September came in this week, showing how much consumers are spending, which is the primary driving force for the economy, but it was completely flat month over month and slightly lower than what analysts were expecting too. This is a sign that consumers are probably pulling back their spending because of inflation and rising interest rates, which is not, generally a great sign. Speaking of which, CPI numbers also came in this week, which is the consumer price index that represents inflation, and that too was pretty bad as inflation remains elevated above 8%, which is not only higher than what analysts were expecting, but it still remains higher than any other point in over like the past 4 decades. I mean, this is a sign that all the rate hikes from the Fed have still not done enough to bring down inflation, despite them already raising rates, I think, for like 5 different times this year. And considering that the Fed has stated many times that they will do whatever it takes to bring down inflation, well, yeah, it's very likely that these rate hikes will continue for some time, despite rates already being at the highest level since the Great Recession and continuously raising our risk of sending us right back into another recession soon as well. Needless to say, expect the markets to remain very volatile for some time. With that said, though, Q3 earnings also kicked off this week with some of the biggest banks reporting last week, and here we saw some of the effects of these policies too. JP Morgan Chase, for example, which is the largest bank in America and also the only bank stock that I own myself, well, they actually posted some good results that beat on both the top and bottom line thanks to those rising interest rates, which helped them generate over 10% revenue growth year over year because of the larger returns that they're now getting on their loans because of those higher interest rates, which sent the stock climbing by over 5% this week. It was a solid gain for them. Citigroup also performed well, beating on both the top and bottom line for same reasons, and that sent their stock climbing by over 2.5%. And Wells Fargo joined the pack as well, with also a beat on both the top and bottom line, sending their stock higher by over 3%. Most of these banks, though, actually saw year over year declines in their profits because they've been putting a ton of money aside because they fear a recession and economic collapse, in which case people may start defaulting on their loans, and thus they need to prepare for that by setting money aside, which is bringing down like their net income. But for example, you had Wells Fargo, their net income fell by more than 30% in the quarter, while Chase fell by a smaller but still substantial 17%. But overall, these banks generally performed well for these earnings. And Banks with heavier exposure, though, to the stock market and other investing markets, well, they actually saw bigger hits. Like Morgan Stanley, for example, this week they fell by over 4% because of their heavy dependence on investment revenue from stocks and other asset markets that have been in decline due to the rising rates as well as recession fears and even the Russia Ukraine war that altogether caused their investment banking revenue to crash by 55% in the quarter, while their investment management sales also fell by another 20% as well. So you can see how, interest rates, higher interest rates, it helps banks, but then you also have a deteriorating economy. Well, that's also going to hurt banks too. So you still need to have a strong economy overall. Either way though, banking stocks, I think they're going to remain volatile for some time because of these reasons, and that's going to be right along with the rest of the stock market. But my favorite among the big banks, that's going to remain JP Morgan Chase. I really like them for their stability as well as their growth oriented dividend of 3.6% that carries a low payout ratio and a solid growth rate of almost 15% to go along with it. I also really like US Bank, by the way, who has a little less growth on that dividend, but it balances out with a considerably higher yield of 4.5%. Plus their sales are growing faster than probably any other bank out there, with 7% growth expected this year and a monstrous 19% growth expected next year as well. And they too beat on both the top and bottom line in this most recent quarter this week. Looking forward to next week, though, earnings madness is going to continue, guys. We've got some huge names coming up here. Now, you're going to have Bank of America reporting on Monday, but then on Tuesday, you're also going to get a huge earnings report from Netflix, as well as Goldman Sachs, Johnson & Johnson, Lockheed Martin, and United Airlines. And then on Wednesday, well, you've got a giant one in Tesla. I mean, I know a ton of people are going to be watching that one, myself included. You've also got IBM, and Procter & Gamble on that day. And then on Thursday, you've got American Airlines and AT&T. And then on Friday, you're going to get American Express as well as Verizon, which is one of my personal favorite dividend stocks. That's going to do it for all of the market news, though. Let's go ahead and move on now to the biggest gainers and losers this past week. Now, I'll let you know if any stocks catch my eye here as well for possible investment. All right, and starting here with the large cap gainers. First, the best performer was Braskem, ticker symbol BAK, at about a 27% gain for the week, which is an oil and gas company, but by far the best performing sector of the bunch here was actually biotechs, as BeiGene, Moderna, Amgen, and Viatris all climbed by around 10 to 15% each. Personally, I love investing in biotechs, especially for their mouth-watering dividends, and I actually own stock in Pfizer, Merck, Bristol Myers, and AbbVie myself. But in the case of this week's best performers, only Amgen and Viatris are the only two out of the four here that actually pay any dividends. Both are pretty attractive though. I mean, Amgen, they've got a yield of over 3%, while Viatris is closer to 5% on the yield. And I also like their metrics on those dividends as well. In the case of Amgen, you're talking about a payout ratio below 50% with a double-digit growth rate and also a double-digit growth history to go along with it. However, their sales are about flat, while their EPS is only expected to grow by single digits over the next 5 years and at the same rate of the previous 5. And after the recent stock bounce, the stock is also trading at about the same levels as price targets from analysts. So even though I like Amgen, I just think there's other dividend biotechs out there in the market with more upside potential. Viatris also has some great metrics though, like a tiny payout ratio of only 13%. So despite it already being a giant 5% yield, that dividend is very likely safe here. Plus, the only reason they don't have a large growth history is because they were actually just recently formed by a spin-off from Pfizer's legacy generic pharmaceuticals division that merged with Mylan to become the world's largest generic pharmaceuticals provider that also owns legacy brands like Viagra and EpiPen. However, because it's mostly a generics business, the growth is really limited here. In fact, sales are actually expected to decline over the next 2 years. And before the merger, Mylan was a stock that had been crashing for many years. So even though I absolutely love the dividend, it's really high, I love it, and low payout ratio, and I think the stock is very cheap at these levels, I'd still rather stick with all the biotechs that I already own myself instead. Apart from that, though, we also saw Walgreens shoot up this week by almost 10%, which just so happens to be the newest stock that I've purchased for my own portfolio. I personally love the valuation and the dividend of Walgreens. And if you want to learn more about it, I highly recommend you watch my recent video that I made on it called Dividend Stocks with Record High Yields that I'm buying right now. And then the only other stocks that caught my eye here on this list are Kraft Heinz that jumped up by over 8%, who is, of course, one of Warren Buffett's biggest holdings. But it's really been a disaster for a long time given the lack of innovation as well as the dividend cuts, so I've never been interested in it. And then American Airlines also climbed by over 7%, but I haven't been that interested in airlines ever since they cut their dividends, and I saw how easily they can be affected by government policies like the lockdowns during the pandemic, which crashed all of those travel related stocks. Moving on though to the losers, the biggest fall came to KE Holdings, ticker symbol BEKE, which is a Chinese online real estate platform similar to like Zillow or Trulia, things like that. It's kind of like the Zillow of China, if you want to think of it that way. But they crashed by almost 25% this week. But it makes sense here. There's still a lot of actually Chinese stocks declining recently because there's still lingering delisting fears here in the States, as well as China's zero pepperoni lockdown policies that are really hurting their own economy. So of course you're going to see a real estate, type of stock crash when China's economy is doing so poorly. In fact, the stock here for KE Holdings, it's already crashed by more than 75% since 2020. So clearly the Chinese economy is really affecting them. I do think that Chinese stocks will rebound over the long term, but my favorites continue to be Alibaba, Tencent, and Baidu, who are all down by giant amounts as well. So those are the stocks that I'll be looking to purchase going into the future. We also saw DraftKings though take another beating this week, falling by another 25%, leaving it now down by a gigantic over 80% from its highs. Guys, I wish I could take a chance on this high flying online sports betting company because I do think that they will become larger over time. But given that they're not profitable and that I already own way too many speculative stocks as it is, I just can't afford to gamble on this stock here at this time. Speaking of gambling though, we also had casinos take a few hits this week, with Wynn Resorts and Las Vegas Sands both falling by around 20% each, who happen to be the two of the biggest casino operators in the world, with very large presences in Vegas as well as Macau, which of course are the gambling capitals of the world here in America as well as in China. But their stocks took a beating this week because mostly of China. Again, people are staying home over there because of the policies, and thus domestic traveling fell by almost 20% year over year, while tourism revenue also crashed by over 25% during the recent Golden Week holiday. Of course, casinos and resorts rely very heavily on that tourism money, so that's why you're seeing these stocks crashing right now. Over the past decade, Wynn Resorts, though, it's been a very volatile stock, with this year in particular seeing it fall by over 30%, and it's down gigantically more if you count from their all-time highs. I actually used to like Wynn Resorts back when they paid a large dividend, but ever since they cut the dividend and after seeing how easily the pandemic can affect them, just like airlines like we talked about earlier, I just lost all interest in ever owning these casino related stocks. I still like to track them though. Anyway, that's going to leave us now. I'm just going to finally mention here two more stocks here that caught my eye, and they were both popular San Francisco tech stocks in Twilio and Cloudflare, each falling by over 17% this week. A lot of people talk about these stocks. I get comments about these stocks, very often, and it's interesting to see how much they've fallen. Twilio is a very popular stock. It's a cloud-based communications company that helps businesses integrate chat, voice, and even video communications into their platforms. And I actually really like Twilio, and I think that they have a lot of future potential, but their stock has been getting hammered right along with the rest of the tech sector because of rising interest rates that make these unprofitable tech stocks more expensive to own on a valuation basis. This year alone, Twilio has already crashed by over 75%, and although I love their really high revenue growth, their losses continue to get larger every year. So it's just a bit too speculative for me at this time, even though I'm really tempted to make a bet on it. Let me know if you guys would want to see a deeper dive on them in a future video. But very similar situation to Twilio is Cloudflare, which also had a big drop this week. And this is a really fast cloud services platform with some estimates placing them as the fastest cloud provider in 71% of the top 1,000 networks around the world. So that's pretty darn fast for their platform. And in that platform, they offer network security and application services, which help other businesses with their operations. From its highs, though, the stock is now down about 80%. And even though I love their revenue growth, I mean, they've got really high revenue growth, but their profits have been falling more and more every year, just like Twilio. And even after the crash, their forward P ratio is still as high as 500, while even their price to sales ratio, that's more lenient. We should be looking at sales because they're not really profitable, but price to sales ratio, it's still sky high at almost 20. Unfortunately, during a rising rate environment, those valuations are just way too expensive for what investors are really looking for at this time. It's really kind of crazy to see just how expensive some of these speculative tech stocks still are, even after all the crashing that's going on. It really shows you just how big of a bubble we had like last year in terms of internet tech stocks that were really flying high because of the lockdowns and all of the free money that was being pumped into the economy. And those valuations just really ballooned up and investors didn't seem to care about it. But now we're paying the price for all of these policies. We're starting to see the consequences of that. We're raising the risk of recession going forward. Valuations are starting to matter again. And that's why you're seeing a lot of these tech stocks, highly valued tech stocks, just really plummet in price. But hey, there's still some great values out there too. So there's definitely a bit of everything. But anyway, in terms of these spec stocks in particular, definitely want to do some more research on them because they are falling quite a bit. And I would like to see if anything might be worth taking a bet on. But anyway, let me know if you guys want to see any of those videos in the future. Let me know if there's anything else you want me to talk about, but also drop comments down below. Let me know what you think about everything we talked about in today's video. How do you feel about any of these stocks? Anything happened for you this past week? I'd love to hear it. Thank you again for stopping by. I will catch you in the next one. Hope you're all doing well. Take care. Bye-bye.